All right, good evening, guys. This is Raj Tekchandani from Smart Capital. And in our series of Smart Passive Investor Mindset, we are taking a look at student housing today. And I have expert guest Jerry Budzinski, sorry if I mispronounced that, and Alex Kogan here as expert speakers. Student housing is an interesting topic. I've done a bunch of research on it, and I have two kids that are in college. So a subject that is very near and dear to me. And I have a bunch of friends who are in the same boat as me, looking at all the expenses they are going through, putting through, paying rents. And I said to them, hey, come on, join this session and see how you can collect rents through the same way that we are paying rents for our students, our kids. So quickly on a couple of things here, I will go through just a quick housekeeping. This is a webinar format. Everybody's on mute. Please locate the Q&A box in your Zoom applications. That's where you please will be entering questions. And we'll take all the questions towards the end. We made sure that we're leaving plenty of time for Q&A. So make sure you enter your questions there. Do not type the questions in the chat box. Let's keep chat box only for if you're having any technical difficulties. And this session is being recorded, so no need to take notes. Just pay attention to what's going on and ask questions. And I'll be sending out the recording. Just make sure that my email is whitelisted so that I don't end up in your spam box. Disclaimer, as usual, this webinar is for educational purpose only and should not be considered as legal, accounting, or investment advice. You should always consult your own attorney, financial advisor, and CPA for legal matters, investments, and tax-specific situations. That said, a little bit about me. You guys, if you have been on this webinar series, you already know me. I'm a techie that turned full-time real estate professional three years ago. I remain passionate about leveraging data, and that's what I try to bring through these webinars. Basically, no fluff data. You'll see a bunch of charts today. From my real estate background, I bought my first condo in 2012, and then I bought several more. That got into multifamily, and I'm a limited partner and a general partner with 650 units as GP. I manage a couple of Facebook groups, data-driven real estate investing and apartment investing and multifamily syndication, also known as AIMS. I'm also a member of the Forbes Real Estate Council, where I write periodically articles. And just to help out my passive investors, I've written a free email course. It's called 8 Pieces of Pie, which stands for Passive Investor Education, and some other guides that go along. You can download these guides at our website. That's smartcapitalmgmt.com. You can also sign up at the course there. Just a quick brief about our guest today. We have two guests today. That's the first for us. Jerry is the Chief Executive Officer at Varsity Campus and directs all aspects of the company's operating investment platform. He's been with Varsity Campus since 2015 and grown to manage about 5,000 beds across the US and another 7,000 beds in the pipeline. I will let Jerry speak of some more about his company and a little bit more details when we switch over the slides to him. Also, Alex Kogan. Alex has been involved in real estate for the last 20 years. He has done a bunch of stuff. I met Alex not too long ago and very impressed by his background in just operating these properties. He started his career in Colorado. You can read the rest. After 20 years, Alex had a successful sale and liquidity event in late 2019. With that, I will pass it on over to you, Jerry and Alex. Take it over. I'll stop my screen share so you can start sharing screen.
Hey, real quick, Raj.
Yeah.
I'm seeing another Alex Kogan logged on. Are you seeing that on your screen?
Oh, really?
Are you hearing some background on that one?
Oh, another Alex Kogan. There is only one and one Alex Kogan, man.
I hope one is more than enough.
All right, yeah.
All right, never mind.
Anyway, we'll figure it out. But anyway, now I will let you guys start sharing the screen, if that's okay.
Okay. Can you see my screen?
I cannot screen your screen yet.
Okay. Let me see here.
What's happening here? I'm seeing. I've stopped sharing my screen, so I don't know why. Are you seeing my screen at all, or what are we seeing here right now?
Just your face.
Just your face.
Just my face, just my pretty face, huh?
It's looking good. Raj, you're supposed to be the techie.
I am supposed to be techie. So now the techie is working, and now you can share your screens.
Okay, here we go.
Yeah, I don't know. Sometimes it hides the sharing screen options.
Let's do slideshow so we can.
There we go.
All right. So
Good.
sorry about that little technical difficulty. As Raj pointed out, my name is Jerry Wojcinski. I'm the CEO of Varsity Campus. That picture there was one of our properties that we manage in Wilmington, North Carolina, or probably rather be at this point. But I've been in the student housing space for over 20 years. I was going to go to law school, but kind of got diverted into the student housing sector by some mentors and advisors in college. Have participated in over 500 million in student housing deals over that career. Have experienced everything from management, development, acquisition, and disposition of student housing assets. In the past, I've worked for some of the largest companies and REITs, EDR, which in 2018 was acquired by Greystar for $2.8 billion. It was taken public by Greystar. American Campus Communities, publicly traded on the stock market, ACC is their stock ticker, and also Campus Apartments, which is a private company, but it's been around the student housing space since the 1960s, based in Philadelphia, Pennsylvania. So I've been around the block for a while, and in about 2015, we started Varsity Campus, which was a management company focused on student housing management that provided REIT-level platform from my experience with the REITs to smaller ownership groups and smaller clients that were looking to get into student housing for the first time. Our portfolio is about 5,000 beds under management currently. About 30% is third-party managed, and 70% we own and operate. We are currently aggressively growing our pipeline, and we are also about to sign a major third-party student housing deal, which would bring our portfolio up to over 12,000 beds, COVID depending, in the next 6 to 8 months. So we are very much growing our platform. We love the space. We have a lot of experience in the space. We have talent from, in my company, from different other companies. They started off at ACC, Berkeley, Campus Crest, Landmark, University Student Living. So a lot of diverse talent on my team. And, you know, it takes a special character to kind of get into student housing. I'll let Alex kind of do a little deeper dive into himself and his background.
Good evening, everyone. Alex Kogan. I've been in real estate for 20 years now. As Raj pointed out, I started my career in construction development in Colorado. Shortly thereafter, I started building a portfolio of real estate that I own personally, and some of that was student housing in Colorado. Started off with single-family duplexes, triplexes, and built a small portfolio and had my exposure to it. Really liked the space, continued on with my primary company, and then started building multifamily, layering that into my own personal portfolio. And then about 4 years ago or so, I started to pivot into student housing on a larger scale and started preparing my company for sale. As Raj mentioned, 2019, late, literally December 13th, Friday the 13th was my lucky day, and sold my company in Colorado as a building development company, design firm, and that allowed me to focus 100% of my time on my portfolio of buying, managing student housing and multifamily.
Hey guys, I think I'm getting some chat here saying that we are not in presentation mode. Jerry, can you check if you're in presentation mode on your slideshow?
Yeah, it says it's, let me try it again.
If somebody can respond on the chat if you're seeing presentation mode or not, That was an old message. Okay. All right. That's
Oh,
we are
okay.
good then.
Oops, let me go through here.
All right. Looks good now.
Okay, good.
Just a list of, current projects that I have, some multifamily in San Antonio, a couple separate projects, market rents, Atlanta, portfolio, student housing I have in Colorado. I've done several developments in Colorado, ground up, mixed use, townhomes, condos. Have done land fix and flips. I think over my career, I've probably have done most asset classes in real estate, and I've transacted over 500 million in real estate construction projects. So that's a little bit about me.
Okay. So to provide a student housing overview, don't know how, basically what the depth of experience you have with student housing is, and modern student housing for that matter. But I figure I'd compare it to conventional multifamily investments or market rate. So in conventional multifamily, you have longer lease terms, you have a stable leasing cycle. Once you stabilize the asset, you're really just kind of maintaining your occupancy. Your renewal rate is higher. You sometimes have tenants that stay there for a couple years, all the way up to a decade or more. That becomes their permanent home. The marketing costs as a result are spread out over a longer period of time, and they tend to be lower. The cost of turning units or make readies is lower in general with conventional multifamily. So, it's also less sensitive to new supply in the market because, in multifamily you have a much larger pool, and really it's as long as you're kind of in a highly desired area of a city or town, you should do well over time, even with new supply coming in line. Student housing is a little bit different. After hearing conventional, you might go, why would you invest in student housing? Because our rent growth is very creative. We change out most of our tenants. About 70% of our tenants are new every single year. 30% on average renew their lease. And then we have, obviously students graduate and move on from college. So we're constantly replenishing our beds. And that gives us every single year the opportunity to push rents between 3 and 5% rent growth. So it really kind of appreciates the value of the asset, really helps with cash on cash, and just kind of provides that growth that sometimes conventional multifamily lacks. Now that does come with some downsides. You do have a lot of pressure to fill up, because once the school year starts, you're pretty much locked in on your occupancy till the next leasing season. There might be some spring transfers, some backfills that you can kind of fill in some beds, but for the most part, the way we look at it is you have a very short window. So you have until that August 15th, September 1st timeline to fill those beds, and once you're there, you're cooked. So there's a lot of pressure on leasing. Marketing costs tend to be a little bit higher. Our turn costs are higher, not so much because students damage the asset any worse than conventional multifamily. We actually have one conventional multifamily in our portfolio, and the damages in student housing surprisingly are less when we turn the unit than in our conventional product. The market is easy to identify. I mean, you have literally a set barrier set by the college. You know where the college is at. You just, acquire accommodations around that university. The closer to the university, the better. So you don't have to play, for example, East Nashville might be a hot multifamily market this year, but next year might cool off and you're on the wrong side of the tracks. You don't have to play that game of where's the demographic going in a certain market. You know forever that the university is never moving. You know where your market's at. You know that the market's going to be stable. You know that students are going to live around that market. So it's really easy to identify where your market is, where your demographic is, and who you should target. There's consistent demand for student housing. We started in the space. Really, the modern day student housing started in the early 2000s. And back then, college markets were gravely undersupplied. And even now, there are many markets that are still undersupplied, and there's still a need for modern day student housing, to come in and kind of play a role in that market. We also have generally lower delinquency. We have leases that are backed by parental guarantees. Students also get financial aid. So between the parental guarantees and financial aid, they're able to pay higher rents than they usually could afford on their own. And they need obviously housing until they graduate. So they tend to pay their rent. They don't want to be homeless and move on without another accommodation. So, and their parents don't want a hit to their credit report. So they tend to pay their rent on time. And they're very good about it. In general, our delinquency historically has been under 0.5% of income, which is generally very good. And it's been recession resilient, which we'll talk more about later. But in general, as the economy declines, more people go back to college to get additional degrees. Sometimes they decide to put off going to the workforce to go back to college and get their master's degree, for example. And so enrollment tends to go up, and so does demand. And we'll kind of discuss this a little bit more later on. This is just some photos of one of our student housing units. This is just to kind of show you how student housing has evolved. It's not the student housing that we went to back in our days, where it was cinder block walls, bunk beds, and 14 of us sharing a bathroom. Student housing has evolved to look very much like market rate. You look at these photos and you can't tell the difference between a market rate product and student housing. We offer stainless steel appliances, in-unit washers and dryers, modern features that come included in student housing that's a little bit different than market rate is we do tend to furnish the units. About 90% of student housing comes furnished. We do provide internet and cable TV or satellite TV, although satellite TV is starting to go away. It's just becoming pure internet packages for students. But those are the types of amenities that student housing like. Parents don't like to come into an apartment and have to fill it with furniture, move furniture. It's stressful enough. So all they have to really do is bring the clothes and some dishes and silverware, move into a beautiful unit. To discuss student housing, I wanted to kind of go into a few slides about how it performs overall compared to market rate. Student housing really from, let's say, the last Great Recession started about 2009 and through 2012, there was, overall all real estate was kind of suffering, and that provided an opportunity to investors with the ability and the cash and the desire were able to pick up a lot of assets in both multifamily and student housing for relatively cheap. We see that in this chart between 2019 or 2009 to 2012, where the cost per bed was relatively at its low point. And since then, it has significantly exploded in student housing. Right now, I would say the average per bed cost is about $85,000 a bed in 2020. And it's projected to kind of come down because of COVID and because of the potential recession. At the same time, there's been a lot of cap rate compression in student housing. We went from about over 7% cap rate to now I would say in 2019, before we went to COVID for a Class A pedestrian property, we're looking at cap rates in the low fours, which is, pretty pricey. And so some of that was because there was a lot of dry powder. Interest rates were good. A lot of people own great assets that are performing very well, and they didn't want to exit. They decided to not hold on to their assets according to their hold schedule, but to extend that hold period another couple of years because the cash on cash was good, the returns were good, the interest rate was good, and so there was very few student housing assets on the market, and it was very difficult. 2019, we personally try to go out there and acquire student housing assets, and we found them to be either overpriced or they were gravely underperforming, heavy value add that we weren't interested in. So finding good core assets was very difficult in 2019, and in some ways we're kind of very happy that this it's unfortunate that we were having to deal with COVID, but we think this is presenting an opportunity for kind of a correction in the pricing and opportunity to pick up some pretty good assets in the markets. This is a comparison on this chart of how student housing and conventional multifamily cap rates have performed over the years. As you could kind of see, there was a lot of cap rate compression leading into 2018. The spread between multifamily and student housing started picking up. I would argue that that spread in cap rates that you're seeing in 2019 is a little misleading. We saw in 2019 a lot of underperforming assets that ownerships got into, back in 2016, 2017, they overpaid for them. They didn't, they leveraged them pretty aggressively and at unattractive rates. So some of these investors that weren't very savvy, got themselves into some hot water and had to, dispose of their asset. So that led to some, kind of divergence between multifamily and student housing cap rates. But for the most part, core assets, pedestrian campus, were still trading at under 5%, in this period of time. Prior to 2009, student housing was relatively unknown investment class. There was some foreign groups, such as the Singapore Pension Fund that was investing. Mapletree, which is another group out of Singapore, poured some foreign dollars into the market, as well as the Canadian Pension Fund. So some pension funds were playing the student housing space before 2009. But it was really a relatively unknown, a stigmatized asset class. People thought students don't pay rent, they're not going to pay high rent, they damage the property. So it was very miscategorized, very misunderstood by blue chip investors. 2009 obviously was the start of the Great Recession, and we saw a tightening in the credit markets. It was difficult to get construction loans. So housing supply, new construction and development kind of tightened up during that period of time. But also during this period of time, the industry proved itself that's recession resilient. We basically knocked every metric out of the ballpark. Our leasing was at the highest level it's ever been. Portfolio-wide, industry-wide, we were at 98% throughout the recession. Our delinquency was under 1%, and it really kind of caught the attention of Wall Street and blue chip investors. And we saw a huge flood of capital come into this space. And people were, really, affecting cap rates and pricing in the space. We kept on building new supply, and it kept on, trading at cap rates of like 4 to 5%. So it became a kind of a really hot asset class the last few years. And we think, again, there's going to be some great buying opportunities in the next year during this time. And you see the sales volume, from 2009, where I kind of indicated this arrow, and just kind of takes off through present day. Just the amount of equity and capital poured into this space was just incredible. We've had a lot of foreign net capital that come in. I think in 2019, about 33% of all transactions was foreign capital. And so during this time, we also had an expectation that the largest companies in the space, the REITs, would just gobble up pretty much all the markets, and it would become a less fractured space, and it would basically push out individual smaller investors. That's actually has not happened. The opposite has happened. We are more fractured as an industry than we ever have before. We have quite a few players that do syndication models, DSTs, other types of capital stacks coming in and acquiring student housing. And I've dealt with more first-time buyers as a consultant in the last couple of years than I've ever had in the last 20 years. So, for the savvy investor that wants to get into an interesting asset class that offers a diversified portfolio, student housing has been very welcoming and very good to them for the most part. Obviously, probably a lot of questions are regarding COVID-19 and how that has affected the space. As you know, COVID-19 pandemic has created an unprecedented challenge for our industry. Universities in March started announcing that they are transitioning the rest of the semester to a distance-based learning model. And that meant no in-person classes. There was fear that the students would leave our apartments in droves and go back to their permanent homes and not pay rent. We expected delinquency to be 30 to 40% secretly in the industry. On the webinars you might have seen with some of my colleagues, they'll tell you everything was rainbows and sunshine, but secretly we had calls and we were a little afraid of what the result would be. We were pleasantly surprised, honestly. Our delinquency in March was very low. We did see a delinquency spike in April, but it's still under 5%, which was much less than we projected. And going into May, our delinquency just ticked up a little bit higher to 6%, but overall, it's nowhere near the double-digit delinquency that we projected. Pre-leasing, we were tracking ahead. It was going to be our best pre-leasing year. We're about 2.5% year over year ahead on our pre-leasing, and the traffic has slowed down and we have lost some of that gain in our pre-leasing. Right now, pre-leasing is down just at about 2% below where we were last year, but we expect that to turn around. And so what we're seeing is a lot of our students decided to stay. About 70% of our students in some of our markets stayed and remained there because they didn't want to go home. And if they're going to do distance-based learning, they want to do distance-based learning in their apartment with their friends. They want to continue the college experience. They don't want their lifestyle cramped by mom and dad. And for those of you that are parents of teenagers, you can understand this. And college markets tend to be markets that are in smaller towns. Clemson is a small town compared to Charlotte, North Carolina, or Atlanta. So they were safer in many ways. We have a property in Winston-Salem, North Carolina, and we have parents that are from Chicago, New York City, and they called us and said, can our son stay there because it's too dangerous back home? And we said, yeah, no one's forced them to leave. They have a contract with us, so they have to pay rent. Yeah, they could stay. And parents were grateful for that. The pre-leasing, on the other hand, is a different story. There was, I think, a little uncertainty about getting into a 12-month lease agreement if we didn't know what the universities were planning for the fall semester. So we really kind of saw the leasing velocity decrease month after month as COVID kind of transpired. And I'll tell you, the first week of June, we're probably anticipating our slowest week yet as far as leasing velocity goes. However, we have received quite a bit of traffic. And so while people aren't committed to a lease agreement, students are shopping. They are calling us, they're taking virtual tours. And there is a lot of pent-up demand for student housing. They're just waiting for the university to make their plans announced. And in markets where the universities have already made their plans announced, we've seen leasing velocity basically come back in full swing. And we still expect all of our portfolio to reach at least 95% or higher as far as occupancy goes. We're really confident that we're going to get there based on the traffic. And it's just a matter of time. It's going to be a later leasing season than we're used to and we're comfortable with. We'll probably be going into the early part of August, leasing up our properties. But there will be a surge, and my anticipation is in July and early part of August, of students scrambling to get their housing before they go back to school. This chart just kind of shows, again, the hardest hit areas around New York City. Our upstate New York portfolio had the highest amount of melt, number of students that left and went back to their permanent homes, but still 54% remained. In the Southeast, which the states there had probably lower cases and the restrictions were less, and I guess the fear of COVID was probably lesser so than the Northeast, we saw the greatest number of students stay. Almost 3/4 of our students chose to remain in student housing for the rest of the lease term. So what we did operationally kind of during this COVID pandemic is we kind of got together as a group, we formed a task force, and we changed our playbook. We changed our leasing and marketing literally within 24 hours. We already had virtual tours set up, so we were well positioned to offer virtual tours online, and we also have an app, the Varsity Campus app. You can get on Android or iPhone and take a virtual tour of any of our properties. We had social media presence, and we really kind of beefed that up by doing virtual resident events, you know, posting contests regularly on social media, just getting engaged with our customer base, engaged with digital advertising that included geofencing, finding our targets, and making sure we pepper their phones, you know, nonstop with our messaging. And then those messages track them no matter what site they go to. Having an online application leasing process. We've been 100% online leasing for the last 4 years. We've always been kind of ahead of that curve in student housing compared to the multifamily space, and just kind of beefing up leasing incentives, you know, offering them certain guarantees if they sign early. So, you know, maybe $100 gift card upon move-in if they commit to the lease right away. And all these have kind of really helped keep us on track and tread water through the slower leasing velocity. Our rent collections, you know, we've just been consistently communicating with our residents. We've promoted on-time payments. So for example, the first 10 people to pay their rent for the month will receive a $25 gift card to Amazon. You'd be surprised at how many students compete to be with one of the top 10 and get that gift card every month. We've offered $200 credit on the balance of their contract if they prepay for the full amount up front. We encouraged automated rent payments, eliminated the convenience fees on credit cards that we normally charge, and just made it very easy and enticing to, you know, make that rent collection payment, you know, now and you know, as fast as possible. We kind of foresaw that as this COVID pandemic progressed, more and more families would be financially affected. More and more moms and dads would lose their job, be furloughed in this pandemic. And so while they still had financial security, we made sure to act and collect as much rent, you know, as possible for the remainder of the contract term up front. And so that really, we think, played a major role in avoiding double-digit delinquency. And on the operational expenses, we obviously renegotiated vendor contracts. We received the PPP loan, which gave us about 2.5 months of payroll coverage, so we didn't have to really furlough any of our team members. We suspended some services such as campus bus routes since there was no more in-person classes. So we cut about 10% of our operational expenses during this time period. You know, I guess at this point, I'll turn over to Alex, you know, to talk about Clemson and how he thinks, you know, certain markets like Clemson will perform in the future.
Yeah, thanks, Jerry. So, you know, we currently have a deal under contract in Clemson, South Carolina, and you know, obviously, my company, my partner investors are still very bullish on the space. Interesting to comment on some of what Jerry talked about in terms of COVID. To give you an example of the opportunities, we have this deal under contract that we're under contract at X price, and we decided once COVID got deeper and there was more unknowns about what's going to happen, we decided to completely re-underwrite our pro forma to be much more conservative, less rent growth, higher delinquencies, and that obviously changed the returns. So we went back to the seller and said, hey, there's a lot of unknowns. We need some consideration because we're taking on more risk. And fortunately, you know, we got a $450,000 reduction in price, and that just allowed us to be much more conservative and basically de-risk the deal. Additionally, we were able to have a 90% revenue guarantee by the seller. So, you know, without going into, you know, detail on that deal, we like the space and we like what's to come in 2020. You know, most schools are already indicating that they're opening back up. There's been a lot of discussion about will we go to, you know, online learning, but as a result of a lot of the dynamics with the schools and the economics and including polls of students, are they enjoying online learning? Overwhelmingly it was no. 90% of the students want to be on campus socializing. And if I go back to why I went to school, at least half of it was for the social aspect. Of course, the other half, the educational. So, we think online learning will become a complement, and by no means will ever replace, at least in the near future, on campus. So we do expect some significant drops in international students. We think that's temporary. That's obvious with what's going on, but we hope to see that come back. Tier 1 schools, we fully intend to see them maintain their enrollment. And, with tier 2 and 3 schools, they may have some issues, but that's only going to bring us more students. If those schools have trouble and, close up at the worst case scenario, that's only going to give us more enrollment opportunity. Another interesting dynamic and opportunity that we see is the COVID effect is students are not going to want to be in tight quarters. They're not going to want to be in a dorm room, sharing a dorm room and sharing bathrooms with multiple students. So we anticipate that's actually going to put more pressure on off-campus housing, and that's obviously what we buy and invest in. So, any additional demand, for example, in a market like Clemson, where we're at, is going to be great for us. It's going to obviously push occupancy to the max and allow us to raise rents even higher. So, we'll watch that carefully and do what we need to do, but we see that as an opportunity. We certainly, Jerry touched on this, we see leasing velocity surge in mid-July. Clemson has already indicated that they're opening back up. They haven't given official notice, but we've seen the football team being called back to go to practice. So those are all good signs. They've indicated, and most schools have laid out a phased approach. There'll be phase 1, 2, and 3. Clemson in particular is talking about a 14-day period of each phase where they'll, keep opening up and doing things accordingly. So, we're bullish. We think, the occupancy will be as it was in 2019. We think rent growth is going to continue and be at a minimum of 2%, and lending and investments will resume. Right now it's difficult to go out and get a student housing loan. Fortunately for us, on the Clemson deal, we have an assumption deal, so we're not getting fresh debt. We have a good competitive loan that we can take over and really, bypass the other obstacles that some investors will have right now. And the distressed opportunities, that's certainly an opportunity for us. We're looking and being fairly aggressive with opportunities, looking at where other buyers have gotten in trouble. Case in point, the deal that we have under contract, we saw an owner that mismanaged the property. We're way under market rents, a number of things. And with Jerry's expertise, who of course is our partner and will be managing that asset, we see a huge upside. So, despite COVID and despite, all the chatter, we're on Zoom calls with some of the largest student housing owners in the country. And with Jerry's expertise, we see some great upside. So we're pretty excited about where 2020 and beyond will be. Here's a slide basically talking about the enrollment growth. So you can see that by 2030 we'll be at 22 million students. So all the data is pointing in the right direction. Again, while some smaller schools may have issues, the tier 1 schools, what we focus on is still very bullish. This is an interesting dynamic to take a look at this graph, and we touched on this earlier about the resiliency and the recession-resistant asset class. Well, you could see that in 2010, when you have a huge spike in unemployment, you're seeing enrollment keep growing. So if you follow that line, that paints the picture, and that's candidly, one of the benefits that why student housing has attracted institutional money. It's recession resilient, and we're excited about that opportunity as well going forward.
So Alex mentioned tier 1, tier 2, and tier 3 schools. For those that are unfamiliar, a tier 1 schools, typically a school has a enrollment over 20,000 students. Tier 2 is about 10,000 to 20,000, and then tier 3 is under 10,000. For the sake of time, I know we have a Q&A. You'll probably ask a lot of questions during then, but to kind of give some insight onto fielding certain markets and certain investment opportunities. There is no one size fits all. I know in market rates, there's obviously usually formulas and metrics that folks like Raj can teach you and advise you during their other educational webinars. And if a deal kind of checks off these boxes, it must be a good deal. There are some formulaic metrics with student housing on a high level, but honestly, every market is very different, and every deal is going to be very different. So typically, there are some buyers that have a box and they won't go anywhere below a tier 1 school. And I was working with a client that was like this. They said, we only want to do tier 1. We want an institutional product at a school that has at least 18,000 enrollment or higher. I found an opportunity for them, and it's normally an opportunity I wouldn't even look at myself. It was at Wake Forest University. It's a private school. It's got an enrollment of 8,000 students. Freshmen through juniors have to live on campus, so only seniors can live off campus. Only about 1,300 students can live off campus. That's a small market pool, compared to like a Clemson, where your market's about 20,000 students plus that live off campus. And I normally wouldn't look at it, but I was asked by a broker to do him a favor and, take a look at this opportunity and do a deep dive. And I did. And I turned around and I went back to my client and said, you have to do this deal. And I liked that it was an affluent student base, that the housing was a niche product. It was cottage style, single family home style, that almost all the occupants were fraternity and sorority members, and they just passed down the house year after year. And there was no competition in the market. And the rents were below what I thought that someone who goes to Wake Forest University should pay. They were below most of my portfolio. So they took a leap of faith, and we did this, and they syndicated the deal. And every investor there doubled their return in the first year. We took out a bridge loan, we institutionalized the product, made some changes, and then we put permanent debt on it. It was a Fannie loan through Hunt, and it was just fabulous. Typically, I would not tell you go into a market like that. And that's just an example of how, folks like Alex will come to me and say, take a look at this deal. What do you think? This checks off my boxes, but through your lens, what do you see? There's also bigger markets that, there's schools that I wouldn't look at. There are maybe blue collar schools, and I'd be more afraid of delinquency or issues with enrollment down the road, but they do fit that tier 1 category. So if you have an opportunity that you're looking at in student housing, you have questions, at the end of the slide, I have a contact. You can contact our Director of Business Development. Our advice is always free initially. We'll make you pay when you start buying the asset like Alex is. So, and I want some time for Q&A, so I'll quickly kind of go over my top 3 favorite markets right now and my worst markets right now. So right now, my top 3 best markets: University of Nevada, Reno, Virginia Tech, and Kennesaw State, which is outside of Atlanta. All 3 of them, same reason, the supply-demand economics are fabulous in all these schools, very hot markets, probably the best, most solid markets out there. The markets I would avoid at this point in time: Middle Tennessee State University, Norman, Oklahoma, University of Oklahoma, and University of Missouri. Enrollment issues at some of these schools. Otherwise, you're looking at really blue-collar demographic and high delinquency, horrible rent growth. And some of them have crime issues in these markets, and I just would not get into them at this point in time. Sometimes markets change, but this year I would avoid those three.
I want to point out one thing that's really interesting on this slide. So Jerry just mentioned stay away from Middle Tennessee University. As you know, Raj, I'm a multifamily market rent investor as well. I have a deal under contract that's market rent in Murfreesboro, which is a sub-market of Nashville. And so it's interesting how you can have a student housing deal in the same town that's a terrible investment and market rates. That's great. So, you have to be very granular and study the data.
Yeah, so I'll turn it over to you for questions now. So.
Absolutely. All right, so this is great. Thank you, guys. That was very, very informational, and a lot of valued information for our audience here who have been traditionally multifamily but wanted to get into doing more of or interested in this asset class. So let me just read out the questions, and you can choose who wants to answer it. Balaji says, what additional legal and liability aspects one should consider for renting by the bed instead of renting by unit for off-campus student housing?
Sure. So when you're renting by the bed, we have a custom lease agreement that we like to use, and we obviously have our attorney vet the lease agreement in every market we go into. It's going to be very different. But for the most part, renting by the bed, there really is no legal liability issues. Aside from just making sure your lease agreement is buttoned up, that the premises is described correctly, that you're renting the actual bedroom and the common area space of the unit, and that you have the right to reassign their room assignment at any point in time. So that way, if there is a major conflict, when you put, let's say, a few potluck roommates together, that you can make that choice and reassign them to another unit. Most of the students that come in do come in groups, so they know their friends. But if you have daughters, you know that even they will not get along with their best friends at some point in time, so you'll have some roommate conflicts there. I think generally our demographic is, the ones that live off campus are older. They've ironed out their differences as freshmen. They're much more mature for the most part, and we don't have any issues there. I will say that when you're looking at insuring a student housing asset, you're going to get hit with a premium on the general liability. There are some student housing assets that are managed by poor managers and owned by poor owners who don't actively supervise their property, and as a result, there are incidences there. And I will give you an example. We took over a property, and the students have set fire to one of the units. They had set dumpster fires. They put the appliances in the tree and set the tree on fire. They drove a pickup truck into the swimming pool prior to us taking over management. We took over, all those problems went away. The town actually gave us our certificate or whatever for being a good neighbor. And we were able to get the GL premium to come down by at least 30%, with proven results. But overall, there's a stigma with student housing, and the amount of claims to student housing is a little bit higher. So your GL insurance is going to be higher on student housing than is multifamily.
This next question says, are there any regulatory or local ordinances restricting off-campus student housing to be rented out only to students or mixed use with non-students rentals as well? So basically, he's asking, is there regulations to just...
So are there hybrids where you have both market rate and student housing? Yeah, we come across that all the time in some deals in some markets. We don't find that the hybrids perform as well as either pure market rate or pure student housing, partially just because, again, when you have more turnover, you're able to achieve higher rent growth. the way we describe student housing, and this is a kind of a legal issue as well, is how do you rent to students and still abide by fair housing, for example? And the way we do this is, anyone can rent in a student housing complex, right? It's just that we limit the occupancy to people that are pursuing education. We have a property where we have a lady in her 60s. She's retired. Actually, she's in her 70s now. She's retired. She moved in when she was 67, and she's now about 74. She has lived there all her life, renting out the entire 2-bedroom, and she's on her 6th master's degree at Iowa State. And she's part of the community. Students, other students love her, and she qualifies because she's attending a college and getting a degree. We rent to all age groups. So we do know that it's not the age group that makes a difference in student housing and having a hybrid form. It's more so the mechanics of operating the property, trying to convince this to investors, the financing, trying to get them to understand what your strategy is. We've seen it, and it operates okay. It's just pure student housing or pure market rate probably operates better.
The next question is, how differently does the lender or lenders treat off-campus student housing from a debt perspective compared to other asset classes?
We've seen no difference. Especially agency debt that are familiar with the product, Fannie, Freddie, we get attractive cap rates. We've been able to apply for green financing on multiple deals. I think before COVID, we actually got a rate of, I think it was 3.27 on a 30-year term with the Fannie loan on the deal. We've seen no change. The same with some CMBS loans. Most of them are familiar. Wells Fargo, KeyBank, those are some of the ones that we typically see on the CMBS side. The ones that you're going to have to kind of convince more is more bridge debt. So we had a group, Varde, come into a deal that were unfamiliar with student housing. I had to educate them. I walked them the market. I walked them the product. I kind of showed them our progress and what we do, the parental guarantees. So those are a little bit tricky, but at the end of the day, they treat it just like any other market rate multifamily product. In fact, they typically like it. If you're getting it at a good cost basis and you have the parental guarantees in place, those parental guarantees are gold to these lenders. And compared to multifamily, we're just doing credit checks.
Great. So I noticed there are some questions that popped up in the chat box. So please, guys, if you have questions, type them in the Q&A box, but I'm going to switch over to the chat box because I see some questions over there. What's the median return on income, ROI, I guess, return on investment, we are looking at student housing investment? I know it varies, but just in the ballpark to get an idea, as I'm new to it. This is
sure.
I
could speak to it from a comparison, at least to multifamily. I think it's similar, but if I had to talk about, returns on the typical syndicated deals that I think investors may look at for multi-family versus student housing, you tend to see student housing just a titch higher. But it's, it's in the range. We see stuff, from an IRR standpoint, anywhere from 15 to 20% IRR. Same, cash on cash, 6 to 8, 9% cash on cash. So it's similar, but I do think there's certain specific deals that have a little bit more upside than the typical multifamily deal. And for me, at least as an investor, I think it's great to diversify my portfolio. I wouldn't be in all student housing or all market rates, but it does have that sort of recessionary protection that I like.
I pretty much, as Alex touched on, development deals are typically 24 to 27% IRR. Acquisitions between 15 and 17% is typical. We've seen some lower, but they usually have better cash on cash. Cash on cash is basically high single digits. I have one investment from a client. They acquired during the last recession property in foreclosure in a blue collar school, which I tend to avoid, but we like this one. It was a good cost basis that we're going in. Is returning with 13% cash on cash. And, that's a unicorn, by the way. And not all of them are like that, but again, we were able to get it at a very, very attractive cost basis during a downturn like now.
Great. And Hassan continues to say that my daughter goes to Virginia Tech and pays 3 figures for her monthly rent, so I know how lucrative that market is. So that's just confirming what you put up the slide there. How long do you hold on to the investment? What will be the IRR? I think you just alluded to that. But how long the hold is typically?
About
I think
5
it's
years. Yeah.
Yeah, I mean, it also depends on the investor appetite and profile. For example, the deal we have in Clemson, we have about a 4.5-year term left on the assumption. In 4.5 years, we'll hit a refi, and investors will get their cash back, and we'll stay in it for a cash cow, or we'll sell if it is the opportune time to sell. So it really depends on your business plan. But I think it's similar to where it's 4, 5, 6, 7-year hold. Depending on your business plan.
Mm-hmm.
All right, Derek is asking, may I ask how's the screening tenants different with traditional rentals? How do you ask parents to co-sign? Do you need to screen the parents as well? Thank you.
We do. So through our application process, it automatically collects the student data, and the student has to put their guarantor's data in, which, by the way, the parent can do it separately. There's a way through the software that we use to send the parent their own application form. But they'll put in their Social Security information, provide a copy of their ID, just like the tenant will. And we run a criminal background check on the students, and then we do run a credit check on the parents. And with that, we have them sign a addendum to the lease agreement, which basically is a financial guarantee. And so they're guaranteeing the contract amount. And so should their tenant not pay, then they know that they will be on the hook for that payment. The agreement is renewable if the student renews, obviously. And the caveat is that we have some students that come in and don't have a guarantor. Let's say you're coming in and you're self-sufficient, you're independent, we allow that too. We just qualify that tenant as if they were a normal market rate individual, do a credit check on them. Typically, they'll pay a higher security deposit because they are a greater risk. So that's usually 2 months rent in lieu of a guarantor. That will also apply for international students because obviously they have parents that would love to be a guarantor, but I can't pursue them in a foreign country. So for the debt. So if they don't have a US based guarantor, then again, they'll pay 2 months rent in lieu of a guarantor.
Okay. And Steven's asking, how do we contact the panel? Steven, I will send out these presentations and all the contact numbers that will be in there for both Jerry and Alex. Kelvin is asking, in a refinance situation, do you have to face any restrictions when approaching agency lenders? Let me read out the whole thing. It's a pretty long. So in a refinance situation, do you have to face any restrictions when approaching agency lenders? ? Agency student debt requires 80% students before they approve. Do you recommend just marketing to lenders that the property is just a multifamily property?
No, I mean, again, we have no issue on financing or refinancing of student housing assets. Yeah, we've had great servicers that have been able to us, Greystone, Hunt, Berkadia, and have had no issues. So I don't know why we would disguise it.
And Kelvin, yeah, you can absolutely approach the panelists. You'll have the email addresses. So for any consultation or questions that you have, that would be great. So let me go back to the chat box again. I think we have gone through all the questions, and if I see, one more comes in. Shelly, my friend from Boston. 5 out of 5. She's asked a question in every webinar. And I was wondering where Shelly is today. Shelly says, do your investors get the same level of depreciation as regular multifamily?
Yes. And we have certain, we do certain things on the accounting side. And we also sometimes do things on the tax side, like cost segregation.
I'll say, yep.
Yeah.
Same dynamic as multifamily. You can, and in fact, for our Clemson deal, we just got a cost seg study from our friend Yona Weiss that I'm sure you know. So yeah, we plan on doing that. And that's a very, very powerful tax strategy.
Right. I mean, the way I would say to think about it, if your student housing and market rate are almost identical, aside from the fact that we rent by the bed instead of by the unit. And that our lease terms are typically 12-month lease terms, and we have a higher turnover rate. But other than that, we operate very, very similarly to market rate.
All right, we just had a few more questions actually pop in. For someone who is just starting, do you have a recommendation to learn more about student housing?
Call Jerry. Call me. I mean, certainly, you know, but it's I think similar to the way I learned in multifamily. Started out small, asked a lot of questions, read books, became a limited investor, learned alongside, and when I was comfortable, you know, scaled up. So it's really no different in terms of the learning curve and cycle. There are probably less materials in books on student housing sort of acquisition ownership than there are in market rent. I actually like that because I think, you know, from an investor standpoint, it's a higher barrier to entry than, you know, it takes more to get your arms around the deal, the market, the dynamics of the school than it does your typical market rent. So from an owner standpoint, I like the higher barrier to entry. Mm-hmm. You got to have a great partner like Jerry and great advisors and know what you're doing.
Eric is asking, how many students are typically in a room?
So the floor plans go, it varies, right? So we have properties that have studios, 1 bedrooms, 2 bedrooms, 3, 4, 5 and 6 bedrooms are a new trend now. We are finding that nowadays 5 and 6 bedroom and 1 and 2 bedroom are the most popular floor plans. 4 bedrooms have lost a little popularity. I don't know why, but you know, there are some units that, for example, if someone took a hotel, converted into student housing, it's all 1 bedrooms. And pretty much all graduate students tend to gravitate towards that floor plan. And also some students who don't want to share their space with roommates. You know, the ones that live in a 4 bedroom, typically they all know each other, or 5 bedroom, 6 bedroom, they obviously know each other. Those that go for potluck, such as international students, or students coming to graduate school from different colleges, don't know anyone locally, will go for a 2 bedroom usually and share that bedroom with someone you assign them to.
Great. Balaji is asking, are student housing syndicated like market rent for raising capital or different mechanisms?
Yeah, identical. You know, I syndicate deals. I'm syndicating the Clemson deal just as you would a normal market rate. You syndicate deals. You know, you see a lot of institutional guys buying them with a different capital stack, but smaller owners, operators like myself, we do syndicate.
I think that's all the questions we have. And if you have any more specific questions on a deal, we request you to take it offline with us. But if there are no more questions, I really want to appreciate everybody for being there, and thank you to our expert guests. Jerry, Alex, thank you so much for taking time from your busy schedules to help educate our audience here. Fascinating talk today. And again, this is all being recorded, so anybody who's registered for the webinar will get a recording, and absolutely love any follow-up questions to Jerry or Alex on just student marketing in general or specific deals. Thank you so much.
All right.
Thanks, guys.
Thanks, Raj.
Thanks, Raj.